Hi, it's Michael Martella, Senior Investment Advisor and CIM. Hope all is well. JP Laporte from INTEGRIS Pension Management Corp. He is the CEO. He is a pension lawyer with over 22 years of experience in the field, very well recognized and distinguished background, especially in this particular space. JP, thanks for taking the time. Again, really appreciate your time. So we're going to be talking about, if it's okay with you, JP, PPP or personal pension plans, specifically for someone who is at the stage of they are selling their business, whatever type of business it may be, whether it's a dental clinic, a medical practice, or any other type of business. The stage of selling, or maybe right before the stage of selling to the stage of selling. So JP, I'm not going to take any more of your time because this is something that at least from my clients that are incorporated and, always come to me and say, well, Mike, I'm thinking of selling in, maybe the next 5 years, if not, okay, but selling a business that is something that you shouldn't be thinking about the year you want to. There's stages, it's a phase, it's a process which needs to be respected, and it needs to be discussed with your professional team, your investment advisor, your lawyer, your accountant, and so on and so forth. Because without it being structured properly, it's just there's going to be so many holes and leaks where it could be extremely inefficient. So I'm not going to keep you anymore. JP, if you can briefly discuss the benefits of having a PPP during the sales stage of a business cycle.
Yeah, so for sure. Now, what's important to remember first in terms of nomenclature, a PPP is a personal pension plan. It's a registered pension plan that's sponsored by your corporation. And contributions are made typically on the basis of salaries paid to you as the employee.
Right.
That's sort of the animal we're talking about. So how does this personal pension plan help in the context of the sale of a business? Well, the sale of a business typically occurs in one of two ways. Either the business sells its corporate assets to a third party, like inventory, client listings, land, whatever the corporation owns, or it's a sale of shares. The shareholder, the client, is selling his or her shares to a third party, and the new buyer is stepping into the shoes of the shareholder and taking over the business. So there are two different ways legally by which you can sell a business, unless there's a third one you know of. This is the two that I'm familiar with.
Right.
So how does the PPP help in both cases? Well, let's take the example of a sale of assets. So it's a corporation that's entering into a sales transaction with a third party.
Yeah.
Third party shows up with a big check and says, I love all these assets that the corporation owns. I don't want to buy the company. I just want to buy all the assets. And I'll take those assets and incorporate them with my own company. So at that point, unfortunately for the corporation, there are certain things that will create taxes for the corporation. For example, classic example is if the corporation purchased a building or land and depreciated the value of that building against its income tax over the years, and now there's a recapture of depreciation. So not only is there a capital gain because hopefully you're selling the property at a much higher market price than what you paid for it, so there's a capital gain that you have to include into taxable income. You also have a recapture of depreciation to worry about. So you're double whammy in terms of taxes at the corporate level. Not a good situation.
Right.
Well, how does the PPP help? Well, because the PPP offers a whole bunch of deductions, which we discussed in a separate segment, and I'll just go real quick: past service, current service, special payments, terminal funding, etc. Those are ways to create tax deductions that offset the tax created by the recaptured depreciation or the capital gain. So we're offsetting the tax with a deduction because we're taking the purchaser's money and we're redirecting it into the pension plan.
Right.
So the corporate entity now is either cash flow neutral or tax neutral, because what it would have had to pay in taxes, it's redirecting into the pension plan. And
Right.
so that's really, really good for the corporation. Now, what about a situation where it's a sale of the shares? So it's not the assets being sold, it's the shares themselves, the property that's being sold to a third party for money.
Right.
In that case, we have a different problem or set of circumstance. Here, typically, the client would like to take advantage of what's called a lifetime capital gains exemption,
Right.
which, correct me if I'm wrong, but it's over $900,000, I think, for 2022.
Correct.
So, how do you qualify for the lifetime capital gains exemption? How do you not pay tax on those capital gains?
Right. Well,
Well,
you have to make sure the company's purified.
correct. And what does that mean, purified? It means that it doesn't have too much by way of passive assets.
Right.
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 Well, how do we get passive assets off the balance sheet?
Well, one way is to flow it through a holdco. The other way is to flow it into a PPP or a mix of both.
Yeah. So what is more tax efficient? Doing an intercorporate dividend after paying taxes, or doing a pre-tax contribution to a pension plan? Which of the two is more tax efficient?
Absolutely into a pension plan, because the corporation's getting a tax credit.
Correct.
So
So
the way I'm looking at it, JP, is if a business either has a bunch of cash or will get a bunch of cash when the shares are sold, that to negate any capital gains on that cash, shifting a large chunk of it into a PPP, getting a tax deduction on the corporate side, will help negate the capital gains tax.
So it's a couple of things. First of all, we're purifying the balance sheet of the company so that the shareholder gets to qualify for this tax-free capital gain.
Right.
So that's the first thing. That's the most important thing. And we're doing it in a tax-effective manner because we're using pre-tax dollars instead of after-tax dollars.
Right.
So that's the one, number one. Number two, in order to create the liquidities to fund the PPP, the corporation may have to sell some of its non-registered investment stocks, the assets that it owns, to create the liquidity to contribute to the plan. When you sell a share, the corporation only has to pay tax on half of the capital gain.
Right.
The other half credits the capital dividends account of the company, which means that now the shareholder can pull money out of the company tax-free, on top of giving the corporation a write-off for any contributions to the pension plan.
Right.
So you got a double whammy, the double advantage that kicks in when you're doing it that way. So not only have you purified the balance sheet so that the shareholder will get that $930,000 tax-free capital gain, what a nice gift, you've also created capital dividend account credits, which allows monies to be pulled out tax-free.
Yeah.
So that's how the PPP can assist in the sale of a business.
Yeah, it's definitely very powerful. Like there's, I'm sure you run into cases, JP, where they've, the clients never implemented a PPP for one reason or another. And, they'll come and see me or they're a new client to me, and they're planning, to sell the business in the next few years, and they never implemented a PPP. And the first thing that goes into and there's cash in the account or in the holdco. And the first thing that comes to my mind is, wow, they could really benefit from past service. They could benefit from so many things on the end stage of the PPP, where I'm sure you guys have implemented a lot of PPP plans at the end of the corporate business cycle instead of implementing it at the beginning, just because of the benefits. Now, correct me if I'm wrong, JP, but there's probably one more benefit that I could think of off the top of my head. Maybe there's more. If it's a family business, right? Is that something that you wanted to talk about? And maybe I stole your thunder.
Sure, I'd love to. So if it's a family business, this is the golden goose, because if the children of the business owner are on the payroll, they're eligible to join the pension plan. And we might even start calling it a family pension plan instead of a personal pension. It doesn't matter. So now you end up with one pension plan with multiple family members participating in it. And when that happens and the children take over the business from the parents, what happens is that if the parents pass away while collecting their pension, instead of having a deemed disposition under the Income Tax Act, which is what will happen to an RSP or a RIF if you can't do a rollover to a spouse, you have a deemed disposition. So half the money goes to the government,
Right.
to the tax authorities. So instead of having this extremely bad consequence with the family pension plan, all the monies that mom and dad left behind when they died is turned into a pension surplus.
Right.
And because the surplus doesn't leave the pension plan, and because the children are also members of the plan, now it's their money.
Right.
And if they don't pull it out because they don't want to spend that money right away, that money will continue to grow tax sheltered for 10, 20, 30, 40 years into the future, creating interest on interest.
So in brief, if we have a corporation that's intergenerational, meaning we have parents and kids that are coexisting within the corporation, and the pension plan is established for the parents, and then at one point is continued with the children, and then at one point the parents retire or leave the business. When they die, instead of having a liquidation event on the pension plan, instead of it being a deemed disposition and rolling into the estate, therefore triggering taxation, the pension plan could be rolled back into the kid's name, kind of back within the pension plan itself. So there's never any taxation. Of course, unless the family wants the cash, there could be a liquidation event and taxes could be paid, and then the children will get cash. But if they don't want it or need it, they could roll it back to their own pension plan, and it's part of the collective of, again. Is that a fair assessment there, JP?
Yeah, it's not really being. It's not like the money is tagged to the children. It just stays in the communal pool. It's surplus because there's no one to pay it to. The
Right.
liabilities have been extinguished, so the money's there. And it just so happens that the children have a right to get a pension from that pool, which includes any surplus. So if they say, you know what, I want to pull out $500,000 because I want to buy a house or a condo, the pension plan can write a check to the children and say, here's $500,000. Of course, you're going to have to pay tax on that.
Right.
But the rest of the money keeps growing tax sheltered.
Perfect.
For long periods of time.
That's awesome. So super powerful tool for any incorporated professional or business owner to use on the wind down or the sale of the business. JP, anything else on this subject, or is that pretty much it?
No, I think that we've covered the sale of the assets, the sale of the shares, and then in the special case of a family business, the intergenerational wealth transfer.
Perfect.
And these can be combined.
Absolutely. JP, thanks again for your time. I really do appreciate it. And anybody has any questions, you can reach me 514-497-7219. JP, thanks again. Looking forward to the next segment.
Yep.
You will.